Good morning. This is Mark Boud of Real Estate Economics. It is Wednesday, July 28th, and you are joining us for our weekly webinar series at Real Estate Economics. This morning's topic is the Phoenix Mesa Scottsdale, Arizona Metropolitan Statistical Area, which is made up of both Maricopa and Pinal counties. What we'd like to do is show you some historical trends in terms of how the housing market has performed and give you an idea as to overall distressed inventory for this market. If you join me for last week's webinar in Las Vegas, this is similar to that, but it expands upon that. It'll only be about 10 minutes long, but there's a lot of information associated with this webinar. I'm going to hop right into it. So, beginning with the cycle, Phoenix real estate cycle, beginning in year 2006, same kind of setup. We pull this directly from our website. These individual blue dots that you see are individual resale records. The green dots are new home builder closings. The red dots, of which I'm not even sure there are any, are foreclosures. And the orange dots, very few of them exist, are foreclosure sales. You can see the overall breakdown in terms of the pie chart, where distressed inventory in terms of foreclosures and foreclosure sales make up a very, very small segment of the overall market. It's dominated by resales. That's a typical healthy market, with also about a third of new home builder closings. Look what happens over the years, though. This is May of year 2006. Here's May year 2007. We get a little bit more distress, not a lot, but there is some bit of increase in terms of foreclosures, properties being lost to the bank, and foreclosure sales, those properties being sold back from the bank to a new owner. Still dominated by traditional resales, as well as a large share of new home builder closings. And here we are in May of year 2008, where we get into a bit more trouble, a lot more trouble in terms of distressed inventory, both in terms of foreclosures, properties being lost to the bank, and foreclosure sales, banks selling it to new owners, generally at a greatly discounted price. You can see what's going on in the overall pie chart. Here we are in May of 2009, where the market really becomes dominated by foreclosure sales. The banks are moving a lot of product at very, very low prices. The prices have just absolutely plunged because of that. You're still getting an enormous amount of foreclosure activity, but more foreclosure sale activity. In other words, we're burning off distressed inventory faster than we're creating it. New home builder closings has fallen to just a sliver of the market, and traditional resales has fallen to about a fourth of the overall market. And here we are, maybe year 2010. Some reductions in terms of distressed inventory, still a very small amount of new home builder closings. Very few new home builders are building, especially the smaller ones that can't get loans in this environment of tightened lending. But resales have picked up quite a bit, partly because our resale category is inclusive of short sales. So in terms of what's going on, what has gone on during the past 24 months, you can see that the Phoenix market has hit bottom in terms of price, and it's actually come up a bit during the past 12 months. I wouldn't call this appreciation as much as simply a redistribution of the types of sales that are occurring, both in terms of geography and type of transaction. But prices have clearly hit a floor during the past 24 months, though they're still way below where they were 24 months ago. This is what it looks like in terms of overall transactions. Transactions have remained about even in terms of single-family transactions, but condominiums have actually picked up quite a bit during the past 24 months. If you break that out in terms of the types of transactions, you get a bit more clearer perspective of this. Here are traditional resales shown in blue 24 months ago. They dropped a year ago, and now they're way up in the most recent month where we have data. In terms of foreclosures, you can see that they've actually crept up during the past 24 months, but foreclosure sales are still above foreclosures. We're still burning off distressed inventory, but not nearly at the rate we were about 12 months ago. New home builder closings has held its own during the past 12 months, but it's still at a very, very low level relative to what it has been during the past several years. And this is what the loan-to-values look like. At 87% loan-to-value, that's high in some markets. It's actually quite low in the Phoenix market, where it's a reflection of tightened lending. And here you see that distribution of sales, where most sales are occurring between $100,000 and $200,000. A little bit of a pickup in terms of the number of sales between $200,000 and $300,000, but from there on, it's a little bit worse than it was about a year ago. And in terms of distressed housing, the way we follow that is we show information for notices of default, foreclosures, and foreclosure sales. Blue is notices of default, and you can see that they very low level back in year 2005 to an extremely high level, peaking in year 2009. And now it's headed down quite a bit during year 2010, and our estimate is that it will fall about 15% from 2009 levels. But foreclosures, shown in pink, are actually rising during this year. 2010 will actually be a net slight increase in overall foreclosures, while foreclosure sales actually drop a bit. The ramifications are that if you take the cumulative difference between foreclosures and foreclosure sales, it gives you an idea as to what the banks are still holding in terms of distressed inventory. You can see this huge increase in what we call shadow inventory year 2008. It dropped quite a bit. It's actually increased for year 2010, and it will head downward as we begin to experience economic growth, and as undervaluation becomes more pronounced and has more of an impact upon potential buyers as we see that economic growth. In terms of how that impacts overall construction and supply patterns, annual supply patterns, and if you add distressed inventory to that, you can see that overall housing supply isn't quite as low, but it is reaching record low levels during the next 3 years. It's just going to take a while for us to burn through that distressed inventory. It'll take a while also to bring up new housing inventory. What that means is that we have a few years of very low incremental supply. That'll give us a chance for the economy to catch up with that. And we think that by 2012, 2013, we actually see some very strong market conditions as a combination of extreme affordability and economic growth combines with low amounts of supply to enhance overall absorption per development. Let me show you some regional comparisons in terms of how Phoenix stacks up with the rest of the markets, or a lot of the other key markets in the United States. In terms of oversupply of housing, we think that Phoenix is about 9% oversupplied. In terms of undervaluation, we also think it is about 42% undervalued. The way we get that is by comparing that long-term relationship between household incomes and median prices relative to where we are right now. Right now, we're paying about 13 cents on the dollar. Phoenix is one of the absolutely most affordable areas in the nation right now. There's only two areas that are more affordable. One is Las Vegas, the other is Atlanta. And just to put that in perspective, we were paying about 30 cents on the dollar of household income in year 2006. So we've dropped about 58% in terms of those overall costs. There are only two areas in the nation that we track that have dropped more in terms of those monthly costs. One is Sacramento and the other is Las Vegas. So needless to say, Phoenix is extremely affordable. If you look at it at a pie chart, here we are in terms of the United States. It's fallen by a little less than 40% in terms of how it compares to year 2006 mortgage costs. Phoenix has fallen quite a bit more than that. And you can see where the rest of these areas rank in terms of how much they've fallen relative to year 2006. That's what we have for this week's webinar. We hope it was useful for you. We invite you to explore our services, both in terms of our online information services as well as our consulting services. Here's our contact information, and we hope you'll join us next week as we present a national webinar presented by my friend and associate John Mulville.